Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Group. It's the Monday main event. We meet up every Monday and talk about all things creative real estate. We have lots of great presenters on, finance guys, insurance guys, developer guys, accountants, all of it aimed at helping you improve what you know and how you execute creative real estate. We also have focus workshops. Donna and I put on focus workshops where we meet up and discuss creative real estate strategies. The last one was September 24th, and we talked about agreements for sale. That was a hugely successful event, and it was so nice being able to do it back in person. It's I think, a way more effective way to help with education. So we're glad we're still doing that. We got more coming up, and Donna will keep you all advised about what's going on. Now, today we are going to revisit a presentation that happened in, I believe, March. We had Garth Chapman on there, and he was telling us about a new CMHC program that increased amortization periods, had some other benefits, worked in some affordable housing, kind of a new program. It was very interesting for everybody. So Garth came on. That was in March. There have been lots of changes, and there's been learning since March. New programs are like that. They're created, they're put out there, folks do the best they can do, and then operationally and practically speaking, things change. So today we've got Garth Chapman back to help us out. Here's Garth. Hey, Garth, how are you doing?
I'm good. How are you, Barry? You're looking well.
Thanks. I'm doing all right. And we also have Neil Shopsowitz on to also give us a hand. Neil and Garth work together. Neil's a reformed lawyer. What a good boy that what can I say about that? I'm going to leave that one alone. I'm going to leave it alone. But we've got a whole whack of stuff to talk about today. So I'm just going to give you a wee bit of background on Garth and Neil. And then we're going to take a look at what we're going to talk about today. So Garth's done a lot of stuff. He's been a business guy for 50 or so years, but real estate investing since 2002. He's been a mortgage broker since 2009. He's handled all aspects of real estate, both on the conventional and the creative side. Owned and operated up to 44 rental units in Alberta and BC, 60 profitable property flips. That's important. Sometimes they're not. Apartment buildings, condo conversions, renovation projects, subdivision, lease options, agreements for sale. Plus, you still got a sweet little portfolio, Garth, that keeps you and Deb in Palm Springs on a regular basis. Is that fair to say?
Pretty close. So all but we were in Palm Springs. Now we're in Phoenix.
In Phoenix. Oh, yes. Okay.
Yeah, we made the move.
And Neil is done a whole whack of stuff. First in Ontario, now in BC. So you've done lots of stuff. I'm reading your bio here, Neil. You've worked nationally, regionally, done complex deals, negotiated complex deals, and folks don't quite understand. I don't think how, because if they haven't done them, you don't know what a difference it is going from buying a house or a duplex to working on a complex multifamily deal or a commercial deal. There's a world of difference in there. Recognition, top 10 commercial mortgage broker by your mortgage professional brothers. That's, I think, that's a big deal. That's a big deal. Wow. And it's all about relationships. So there's emphasis here on how you've been able to establish relationships, which is always great. If you've got the great connections with lots of organizations and they like you and respect you, I'm pretty sure that's a huge help to both of you guys in finding money and helping your clients. And maybe last and most important, you have correspondence status with CMHC for multi-unit residential. Instead of me saying what that is, why don't you tell people what it means to be that and why it's important?
Well, I mean, in a nutshell, I can go directly to CMHC to get a certificate of insurance. rather than having to work through an approved lender. I can negotiate directly with CMHC. Once I get the certificate of insurance, then I'm free to go to the market and choose whatever lender is going to be the best lender for the deal.
Sure.
Rather than, if you go through a broker who's tied to a lender, or if you go to one of the lenders, you don't really have a lot of flexibility.
Yeah.
So it's hard to get, and it's a great asset, and I'm lucky to have it.
No, I couldn't agree more. I've done a lot of fiddling around with multifamily deals, and they always go better when that rare broker who has correspondent status is involved. I know that for sure from personal experience. So with those intros, we've got a really interesting and full program today. Garth was kind enough to send along notes, just a couple of notes about what he thinks we might talk about today, which take up a whole page for his short summary of what's going on. So, Garth, why don't we start with reviewing what we talked about in March for the MLI launch that was brand new then. So why don't we start there, and then we'll work ourselves up to what's happened from then till now and what it all means.
Right. So when I came on your, I was going to say your show, Barry, and it kind of is like a show. When I came on your show, I think it was either February or March of last year, and this thing was being launched, and we were, without having the correspondent status with CMHC, we had to work through lenders, so we had some learning to do there. We've done lots of conventional stuff, but the insured stuff was a little tougher. This program came about, and CMHC was pretty, in their launch video, the fellow who led the team that put it all together was pretty sticking to the line items in the book on what they were prepared to do and likely to do and not do. And as it turns out, and Neil can speak to this, they have ended up really lightening up, I think, from pressure from brokers and big institutional borrowers. And they've made this program much more effective and useful in markets in Western Canada, in particular in Alberta. You might remember me saying, I'm not so sure how well this is going to work here if they do this and this and this, but it has worked pretty well. And so pleased to say that. And then, of course, the thing that we learned after, a year of working on it was we really need to have correspondent status. That's a heck of a challenge to get. That's a big bar to jump over. And so Croft knew Neil, introduced us, and I went, you know what, let's go this way. This guy knows what he's doing. He's I don't know, close to 1,000 deals, Neil, in the last 16 years, commercial only. So why would I try to figure all that out at my advanced years? I'd be almost as old as Barry by the time I had it half understood. So why don't I just partner up with Neil, and away we go. So here we are, and I can't say enough good things about how well this has worked for us. We bring different things to the table. I try to look after some elements of this for us as a team, and Neil makes the deals happen, and here we are. So
now, just go back a little bit for folks who weren't around in March and who don't really know what this program is like and why CMHC added it on. Can just give us a bit of program background? What is it? Why is it new? Why is it and why is it important before we get into what we've learned over the
right.
year?
Well, it really, and I'll turn this over to Neil in just a second. I will say that it was really an outgrowth of the current federal government's desire and push to create more affordable housing in Canada, which is certainly a good need. And on this one, I think they've done a pretty good job. They assigned this to their Crown Corporation, CMHC, who came up with this program, and it is working. Where you've got a reasonable deal, it works. And it doesn't matter what part of the country you're in, to a large degree. So maybe, Neil, with that said, if you could explain to our listeners the essence of this program, in 20 words or less, or 200.
Sure. Well, the other thing too is that back in March, before the rate increases started to come fast and furious. This program was attractive. It's a lot more attractive now. Given where current rates are and the fact that cap rates really haven't moved very much, it gives you the ability to buy a multi-unit residential property or develop a multi-unit residential property, at some reasonable loan-to-value ratio in most markets. If it wasn't for this program, I think in a lot of markets you'd be looking at a minimum 50% down or 50% equity into the project to make it work. But yeah, I mean, as Garth said, the program was developed. Basically, there's three sides to it. One is to help provide more affordable housing for Canadians. One is to promote accessible housing, handicapped accessible. And the third is to promote cleaner or more energy efficient housing for Canadians.
Okay.
So,
all right. Well, those are certainly laudable goals. I mean, the media and discussions are full of the despair that people are experiencing when they think about, can I ever buy a home? Accessibility is a huge issue. Climate change and the green things that we need to do are coming more and more to the fore. So it looks like the government's, hitting all the hot spots here with this particular program. Tell us a bit about the affordable side of this. Is it a brand new program where you just couldn't really get financing for affordable type housing before this came along?
well, what this does, and it makes it fairly simple. It's a points-based program, and I mean, ideally, you want to get to 100 points. If you get 100 points, then you can get the maximum amortization, which is 50 years, and the DCR is always going to be 1.1 once you start getting into the points program, and the minimum that you need to get is 50 points. On the affordability side, which I think is probably the easiest to satisfy, particularly in a lot of markets where rents are under market. There's been rent control in certain markets for long periods of time, or you have buildings that just have tenants that have been there forever. But the government puts out, and anybody can find it, a chart which lists median income for all major markets in Canada, and then it has separate. If they're not major markets that are listed, they have urban and rural median incomes set out. And if you fall within the 30% median income and you commit to keep a certain percentage of your units at that level for 10 years, then you'll get a number of points. And it's different on new construction. To get your 100 points, you have to keep 25% of your units. On existing buildings, you need to keep 70% of your units at that. But you look at a market like Calgary, for argument's sake, which where the median renter income is fairly high. If you kept on new construction, if you did 25% of your units at $1,735 a month or less, that would get you 100 points, and that would get you a 50-year amortization, and on the 1.1 DCR and best CMHC rate, which right now is roughly 1.8% below the going rate on a conventional. So it's a big advantage, even on existing construction. If you're buying existing property, if you kept 40% of the units at 30% of median renter income or less, and you committed to do that for 10 years, and it indexes as inflation goes up, that would get you 50 points, which would still get you the 1.1 DCR, and it would get you a 40-year amortization, which, and the 1.1 DCR is a big deal. Do people know what a debt cover ratio is? Or should I?
They probably mostly do, but since it's an essential term, why don't you give us
It's a ratio. Your loan payments have to exceed your income coming off the property by a certain ratio. So traditionally with CMHC, it would be 1.3. With most conventional lenders, it would be 1.25. On the MLI Select, it's 1.1. So your payments only have to exceed your income by 10%. So it allows you to get a much larger loan than you would otherwise.
Okay. All right. And so without a program like this, I guess what you were saying is it's pretty darn tough to finance a project. I mean,
Well, finance a project or, a new purchase. If you were buying, let's say the cap rate today is 5%, which it's probably, in a market, which it probably isn't. If you were doing MLI Select, you would be able to get, probably pretty close to 80 or 85% loan to value using the points program. And if you were doing traditional CMHC or conventional finance, you might only be able to get 1.3 million. So it makes quite a big difference in terms of what you can do. And there are other components, especially on a new build. It would be easier. I mean, if you combine, if you don't want to commit 25% of your units, let's say you only want to commit 10% of your units or 15% of your units on the affordability program, but you want to do part accessible and part to meet the energy standards that they're trying to get to, you can get your 100 points that way and still get the best financing.
all right. So going back to the start of the program, I mean, let's not beat it up too much. Garth, did you have something there you wanted to say?
Just one thing to recognize, and just about all multifamily buildings of any size and description or location will contain various sizes of units. So bachelor suites, 1 bedrooms, 2s, 3s. CMHC, as Neil likes to say, CMHC in its wisdom didn't differentiate. So you can have virtually all of the units that you designate as affordable can be your lower value units. So in many markets, that means that even though you're stuck with the affordability that you've committed to for 10 years, and it will go up year by year as the incomes go up, and StatsCan does their adjustments to all the numbers. CMHC will pick that up, and you'll get 2 or 3 or so % increases. Those rents will be. It'll be a long while, I would think, before you would get to a point where you weren't getting essentially market rates.
Okay.
Right. So as a real life example, we have one that we're doing right now, which is 4 2-unit properties that are all side by side. So it's 1 8-unit complex, and it consists of a basement suite, 1-bedroom basement suite, and then a 2-bedroom suite upstairs. I think 2 2-bedrooms and 2 3-bedrooms. So all the 1-bedroom basement suites are. And it's in the Edmonton market, which is similar to Calgary. It's a little bit lower. But all the 1-bedroom units easily fall within the affordability guideline. So that property will qualify for, and it's new, so it'll qualify for a 50-year amortization and the 1.1 debt cover ratio. So the loan to value on that, I mean, in the end, you're still limited by the income. So it's very hard to get to 95%, which in theory, also, you can get on MLI Select 95% loan to value or loan to cost, but he'll get 85%, which is not bad.
No, that's not bad.
Market.
Not bad. So without beating up the original program too much, a lot has changed. Maybe Garth, hit me with the top 3 things that were a little too tight, a little too sticky, a little too not working. That have been adjusted as we get to today.
Well, I think the first one was, they've allowed borrowers over time to change which units they designate as affordable. As people move out, they want to do a renovation. At the launch, they said they weren't going to do that. Okay. So that was, I think, a good one, particularly in older buildings. Others, Neil, that you could think of that have changed?
I don't think anything else has really changed. I mean, probably the one thing that has changed is how long it takes to get these done.
Yeah, huge.
Because they're busy, and and they still, most of the CMHC people are working remotely still. So
Yes.
they're not really efficient. And so it makes it difficult on a purchase because right now, if I put an application in today, it will be a minimum 4 weeks till I get an underwriter assigned, and then probably another week and a half until the underwriter actually starts to look at the file.
Right.
And then, assuming everything goes well, probably another 2 weeks after that to get a certificate of insurance. And then from there, probably another 2 weeks to get a commitment. So, on a purchase, it's difficult to get that length of time for subject removal. On a new build, it's not as time critical,
No.
but on a purchase, it's an issue.
So I didn't add up all those time periods.
So you're probably about nine and a half weeks to get a commitment,
Nine
and
and a
then
half
3
weeks.
and then 3 weeks to close after that.
Yeah. Yeah.
And that could go up because, for 2 weeks now, between probably December 21st and January 4th, people are still going to be sending in deals, but there's not going to be many people processing them.
No, those are going to take an extra couple of weeks for sure. So, Neil, one of Garth's talking points here, and I think you may have just covered this. We'll just see if you want to add anything else. Neil will tell us all about how in commercial lending, how the NOI, the rate, the amortization period, and the minimum DCR determine the mortgage amount. Now, you were talking about that very thing. Is there a wrap-up comment you can make on that, or do you think you've covered that enough?
I think I've covered it. I mean, in the end, it's a math exercise.
Yes.
And it's, very much so. And the mortgage amount it's not going to be determined, as in residential by your personal TDS and GDS. It doesn't matter. I mean, CMHC and the approved lenders like to see that the borrowers or the guarantors are strong enough so that, if something happens to the building, they're in a position to backstop it. But the loan is going to depend 100% on the income that comes off the property, and then the applicable rate and DCR are going to be applied to come up, and amortization are going to be applied to come up with the maximum loan amount.
Okay.
So
all right.
the just to add to that, Neil can turn these calculations around extraordinarily quickly. When you find an asset that you think, as it's met your requirements to this point, you've gone through your funnel, you think this one's worth looking at, just send it to us. Send us a rent roll, send us your pro forma, the listing if there is one, and within a day, generally within a day or less, you'll have an assessment of what mortgage that will carry, and along with a rough outline of the fees and closing costs you can expect. So you can quickly now decide, okay, does that meet my criteria? And do I want to move forward?
Well, that's excellent turnaround. I know investors flounder a little bit when it comes to multi. I mean, they're steeped in the single family or the residential side of it. And when it turns to multi and the commercial side of it, they flounder around a little bit. So folks, I hope you listen carefully to what Garth and Neil are offering you here, that within a day, so why don't we say 2 days? A day seems so fast. My goodness.
Actually, I could, depending on what's going on, I can usually do it in a couple of hours. But I mean, the thing that you have to watch for also, and if you're looking at properties and, you don't know yet what you want to do, but you'll start to get a feel for it also after a while. Quite often, I mean, the really good realtors do things the right way, but not all of them do. So, you might see a pro forma and there's nothing for management because the owner manages it himself and he doesn't pay anything for management. And there's nothing for vacancy because they don't have any vacancies. And there's very little for repairs and maintenance because they haven't had to put any money into the property in the last couple of years. But for financing purposes, there's certain benchmarks or standards that you have to put in, whether or not you're incurring those expenses or not. It's called stabilizing the income statement or the pro forma, and and that's something that I do when I run the analysis. And if you send in a few of these, you'll start to see very quickly, what the realtors may be missing when they send you packages to look at.
I think that's important for people to understand. They come across what they think is a gem of a property, and those property management, repair and maintenance factors haven't been taken into account. What you're saying is they have to be taken into account, and you will insert those into any numbers that you're running because you have to do it. So folks, just remember that's what will happen when you send along pro forma, rent roll, and the listing if you've got it. Were those the three things?
Those are the three most important things.
Okay, so we have contact details for Garth and Neil. And who should it go to? You guys, should it go to either of you, or
Ideally send it to both, and then
okay.
as I've done today, we had a couple of emails today. I've called both those people, had rather lengthy conversations about what they're trying to achieve, so then I can direct them as to what we think might be their next steps. And then we'll get something into Neil once they've got to that point. And that keeps Neil free to keep running those numbers within a couple of hours or a day.
Okay. All right. So that's a very generous offer from you. Donna is making sure your contact details are up for everybody to see. Neil's was up. Garth's up now. Let's talk about the actual qualifying NOI and how that differs from sellers or realtors pro forma NOI amount, unless that's what you were just telling us.
Yes.
That's pretty much what we were just talking about.
All right. They differ because people forget to take into account the factors that you have to take into account.
Yeah, okay. I'd say the two most common are management and vacancy.
Yeah.
And right off the bat, that's 10%.
Yeah. Okay. Management, vacancy, 10%. And then repairs and maintenance, what would that add on?
The current standard for Alberta is $750 per suite per year. And then they introduced this recently, $50 per appliance per year.
$50 per appliance. Oh, okay. All right.
So,
right,
most suites would have 3 or 4 appliances. So you're basically looking at $950 per suite per year.
Yeah.
If it's 7 or more units, you also have to put in a on-site manager or caretaker allowance of $450 per suite per year.
And I think the other thing to remember is that insurance costs, as we all know, in multifamily buildings has been going through the roof. Maybe worse for condo units, individually owned. But I think, Neil, if I'm not wrong, the insurance numbers we're seeing now are trending. They're a little lower than what we're seeing on the renewals. How is CMHC allowing you to report the insurance where we have a renewal coming up in the next 2, 3, 4 months?
Well, best evidence would be a quote. So, I mean, they have their benchmark, but if you can provide a quote that's better than what their benchmark is, then they'll accept the quote as long as it hits all the requirements.
Okay, quotes are always good. I'm just going to pop up a question or two.
Which one? Can I do the first one?
Good, Donna, you put one up here. Cody Lee says, perfect timing. Do you know the details on MLS Select to buy new multi-build suited homes at once? Multiple new build suited homes at once. You want to buy 4 separate units, suites up and suite down? You were just talking about that for the deal you got going in Edmonton or something like that.
I mean, the general rule would be that, as long as the properties are side by side, operated as one development, then as long as it's 5 units or more, it would qualify. I'm not sure, are they talking about a house with a suite in it, or I'm not quite sure on that question what they're looking at.
I guess if they're all together, that's one thing. If they're spread around the city or around the province, that probably wouldn't work.
I did in 2020 and 21 a series of duplexes and half duplexes where you would buy a full duplex. This was new construction, full duplex with legal suites below. That's 4 units, and buy half the duplex beside it. And now you've got 6 units, and those applied. I did have a query from a client. Oh, this has got more than a year ago, about doing a single family house with a legal suite in it and a carriage house, or a suite above the garage. And the lender I spoke with said absolutely not for any single family home, no matter how many units were added. Neil, is that still the case, or was that correct?
I've never done one with a single family home, and if it's not a legal suite, you can't count the income from the suite as part of your application.
So we'll check on that, Barry and Donna, and get back to you. But I think we're going to hear that single family homes don't work. But if it's configured as a duplex or a triplex, fourplex, and there's 2 of them, and you get past the 5 units or to 5 or more, that should be fine.
And the units are self-contained.
Yes.
Okay, so she thinks it's a all suited 5-plex.
All suited 5-plex. I think it's all in one 5-plex, all suited.
Yeah.
Okay.
Should be good.
Then that would be fine.
George has a question. He's in, I think, Nova Scotia, certainly in the Maritimes. He was wondering if you can help folks in the Maritimes with financing.
We can, and I've done probably half a dozen deals in the Maritimes in my career. The challenge, depending on the market, is that the loan amounts are usually on the low side, and it's really hard to get lenders to do loans under $500,000. And if they do them, it's not going to be best pricing.
Kind of not worth their while for the small amount. Is that what it comes to?
Yeah, because they get killed on the servicing of these smaller loans,
Right.
and so they just don't really want to do them. They don't want to have them on their books.
Yeah.
And I know they're not small loans to us, but in lending world right now, anything under $5 million is considered a small loan, and under $2 million now is harder to do. There's only really a couple of lenders I can go to that'll do them. And on construction, if it's under $5 million, there's probably only one lender I can go to who has decent pricing. Otherwise, the pricing on the construction side of it's going to be high, even with it being an insured loan. Because it's just, they're a lot of work. Construction loans are a lot of work for lenders.
Yeah. Yes, they definitely are. They're definitely a lot. Now, I think we've got some case studies. I love case studies, so I want to get into the 3 case studies we've got. I just want to make sure that we've introduced MLI Select enough, including discussing the points system. You get different points for different things. I mean, we didn't go over in minute detail what gets you points or not, but if we think we've covered that enough, have we also covered the loan to value range to folks can expect on existing properties on new builds? We touched on that.
We haven't really. Okay, I mean, the first thing that we haven't touched on is net worth requirements.
Oh, okay.
Okay,
Yeah.
so when it says that they're looking at minimum 25% net worth to support the loan, 25% of the loan amount, that has to be outside of your down payment. So if you're buying something for $1 million and you've got to put $200,000 into it, they'd be looking for $250,000 in tangible net worth outside of that, and decent credit. and you know, and they're going to look at your entire portfolio of other real estate assets to ensure that they cash flow and that you're not in a negative cash flow position. And, you know, again, their main concern is that if something happens, you know, if we ran into another COVID and you lose tenants, or you need to replace the roof or a boiler, that you've got the ability to do it. And, you know, if the loan to value is really pushed, you know, they might look to a higher amount, you know, it might be 35%. So tangible net worth, you know, obviously cash, you know, investments that, you know, are marketable securities or mutual funds or, you know, anything like that, as long as they're in this country, you know, would count. Equity and other real estate, you know, would count as tangible assets. You know, they'll use RSPs or RESPs, but they'll discount them by 50%.
Tax.
You know, what they don't count is your car collection or your art or your jewelry or, you know, things that are not easily convertible to cash. So that would be one thing. On construction, you know, they may be looking for a bit more because there's two components to your guarantee when you're doing construction. One is the loan amount itself. The other thing is that you have to provide a completion guarantee so that if the project runs into cost overruns, which so often happens now, you're there to, and you know, you're able to backstop it. So depending on the size of the loan and the loan to cost, you know, they may look to 40, 45, 50% in tangible net worth outside of what you put into the project.
That's big. Wow, that's a big factor in terms of whether somebody's going to qualify for a loan.
Yeah,
that much.
Yeah, and construction loans for MLI Select are the same as basically all construction loans. They're done on what's called a cost to complete basis. So all your equity has to be in first before you can start to draw on your loan amount. So, you know, again, for argument's sake, if your loan is going to be $900,000 on a project that's $1 million, your $100,000 equity has to be in there first before you can start to get any advances.
Yeah. Yes, indeed. Wow.
Okay. I think, Neil, could you speak just briefly to cap rates and, you know, what cap rates, roughly speaking, will get you to 80, 85% loan to value?
Sure. So, you know, right now, CMHC is using a 5% as a qualifying rate. It doesn't mean that's what the rate would be. And depending on the size of the loan, you know, right now, you know, the rate would be probably somewhere between 4.25% and 4.5%, depending on the loan size, 4.55, somewhere in that range. But to get to 85% on a 40-year amortization, which is what most existing properties are going to be at if you're buying an existing property, you would need a 5.25 cap to 5, and on new builds or on new properties, you'd need around a 5 cap to get there.
Okay. All right. I see we have quite a number of questions. We've got 3 case studies to do. Let's take, say, 2 or 3 more questions, and then let's get into the case studies. I'm interested to hear in that.
Okay, so there's one.
All right, Sam Lee says, is MLI Select must be a 10-year term mortgage because of the 10-year affordable commitment? Is the mortgage breakable or assumable?
Okay, it can be a 5-year term, but you've made a 10-year commitment. One thing that we don't know yet, and I've tried to find that out because we haven't got there because it's so new, is that at the end of the 5 years, if you just want to pay it out, are you still committed on the rental? And I don't think you are, but I don't want to tell you 100% that you're not. Okay. Are these assumable? They're assumable just like any other insured mortgage, but the borrower has to go through a qualification process. You will not be released from your guarantee for the initial 5-year term if you're on a 5-year term. and it will cost typically around 0.5% will be the assumption fees.
Okay. All right, let's go for another question here.
Okay, it's up.
As Trevor got to say, would CMHC consider a new build that just received occupancy in October as an existing building or a new build? So it's only not even 2 months old yet, roughly. Is that a new build?
Well, I don't, because it's just built in October, there'd be no issue getting the 50-year amortization.
Okay.
So I guess the bigger question is whether or not you'd have to have 25% of the units or 70% of the units to get the 100 points.
It's a big question.
Yeah. I mean, I guess the short answer is I don't know, because I haven't had that and I haven't run into it.
I think I would say send us an email with the details, the specifics. If you've taken possession, presumably you have a mortgage already. Maybe you paid cash, but send us the details and let's see. We'll do some research.
Yeah, I mean, the other thing is too, if it's a new build built in October, it might meet some of the energy efficiency requirements.
Yes. Yeah, probably would. All right, let's do one more before we get into case studies. All right, gentlemen, do you have a rough percentage of MLI Select Finance buildings that are using the accessibility points for attaining points?
I have yet to do one, which, most buildings have a first floor, and I would think that it's not terribly difficult to convert some of the units to meet the standard. But I have not done one yet. I haven't seen anybody. Actually, I don't know anybody who's done one yet. I've seen some on the energy side, but I haven't seen any on the accessibility side.
So point gathering is more on the affordability side than it is on the other two point getting methods, it sounds like.
Well,
the affordability is the easiest.
Yeah.
And on existing buildings, it's the easiest. You're not going to get energy. It costs prohibitive to get the energy on an existing asset. And on the accessibility, it really depends how old's the building, how wide are the hallways, how wide are the entry doors. Yeah. Can you make that work, as Neil says, on the main floor and get some points? But it's such early days that it's hard to say at this point.
Hard to tell. Still developing for those aspects. All right, let's get on to case studies. We've got a new build in Ontario. You want to talk about that one?
Yeah, I mean, I think the main point I wanted to talk about on that one, and what was interesting on this one is that the borrower, the total project cost, including land, and you can include land as part of your budget, because it is part of your budget. So the total project cost, including land on that one, was about $2,350,000. Excluding the land, it was about $2 million. So the borrower went into it saying, I don't really want to owe any more than I have to, and I've got another $100,000 to put into it. So I don't want my loan to be more than $1.9 million, which is very straightforward, and the projected cash flow easily supported that loan. But then and we actually had a COI issued on that basis. But then he came to the realization in today's world, because of supply chain issues, there's so many things that you have to order well in advance and that you have to put down significant deposits for, and you cannot get a construction advance based on deposits paid, or based on even if the materials have been delivered somewhere but they're not installed. You can't get an advance on that. Advances are based on work in place, not materials on site or deposits. And so he realized that he was going to be very tight on cash flow. So we were able to go back and, if you have substantial equity in your land, this really helps. He owned the land clear title. So we were able to go back to CMHC and very quickly get the certificate of insurance amended and increased by $150,000, which is what he needed basically to have as a float to allow for him to have sufficient money to work for, to deal with deposits or anything else that might come up until he was able to get the work in place. So, you know, my advice to anybody who's looking at doing a construction is don't cut things too tight, because you are going to need a float to do stuff.
Things happen in new construction. Anything that is being built, renovations, new stuff happens. Yeah, you cannot cut it too tight. It's one of my certainly things I say to my clients all the time is don't budget this to the penny, you guys. You'll end up spending the money, so don't do it. You'll kill yourself. So that's
So I mean, they require, which most construction lenders do right now, 7% contingency on your hard and soft costs. And they also require, all major trades to be fixed price contracts. And on larger jobs, they'll require bonding or partial bonding. But, I've still seen, trades just walk away and, on a fixed price contract and say, sue me.
Yeah.
But they just, if they can't complete, they can't complete.
Yeah. No. Yeah, that happens, folks. Hey, I've got a contract. Yeah, great. Doesn't always protect you. So should we move on to the Alberta refinance? Anything more about the Ontario case study that we want to talk about?
No, not really on that.
Okay.
I mean, the only thing I will say, it's difficult to place it at a decent rate because it's considered a small construction loan, even at $2 million.
Still small. Yeah. Yeah, folks are going to have to get their heads around that part.
Yeah, the takeout will be fine, and the takeout will be at, at a very good rate. But the construction's not going to be at a great rate. No. But, when you're doing construction, and, I always tell people to bear in mind that whatever the interest cost is, it's only really on half the money, because you're paying your interest on advances. So if your construction period is a year, really you're only paying it on half the money over the year, not all the money.
Okay.
And so, the difference between prime plus 1 and prime plus 2, or prime plus a half and prime plus 2, may not be that significant in the overall scheme of things.
Yeah, they have to look at those numbers carefully.
I think the other thing to add to that would be that, when you do the construction financing under the terms of the CMHC approval, it means that construction lender has an out. They know they're going to get paid out when the thing completes, because the COI is in place. And Neil, can you add to that anything at all, or just is that a general comment?
Well, so I mean, again, you're limited by the pro forma income at the end of the day. So, in theory, you can get 95% loan to cost, but if your pro forma income at the end of the project will only support 85% loan to cost or 90% loan to cost, then that's going to be the limiting feature on the construction loan.
Okay. Barry, I think there's one other thing we should talk about that I did not get in my notes, but it was an issue when we spoke all that time ago. And at that point, I wasn't working with Neil. I was working with a lender, or two lenders, actually. So we had issues on new builds with a CMHC requirement under the old program that the property be fully leased before you could put the mortgage on. So you ended up with bridge financing to close the deal, then get it leased up, and then bring in the CMHC financing. And that could be expensive. Yeah. And that's not the case with MLI Select. So maybe, Neil, if we could talk about that a little bit, that would be helpful.
Well, it's easy. If you look at the table, it's got one word for rental holdback on every column, which is waived. So not an issue.
Okay, well, that's wonderful, because that would be quite an issue. So we're going to move on to a refinance in Alberta. What about that?
All right. Well, okay. So, I mean, the interesting thing on this one is it was a transaction which I think the borrowers felt, I mean, I didn't act for them on the purchase, but they felt that they got this property, I think, at a very advantageous price. They didn't have time to get CMHC financing then, or conventional. So they ended up with vendor financing at 75% of the purchase price. When they purchased and then and then they wanted to, and it was supposed to be for 6 months, I think, and then it had to be refinanced out. So there was some time urgency, although the vendor's been pretty cooperative through the process. So when we were approached, I looked at it and I said, okay, this is a perfect MLI Select deal. 40% of the units are easily, within the 30% of median renter income range, and likely won't exceed that for a long time, if ever. And I think in Edmonton right now, that's about $1,630 a month, if I remember correctly. Mm-hmm. So it was a perfect MLI Select deal. The other issue is that when we started working on this, they only had owned it for about 8 months. So they didn't have a full year's operating statements. And the vendor really couldn't provide anything or wouldn't provide anything from before. But what we were able to do was to get from the various utilities a year's worth of utility bills, which you can use in substitution, and then create an income statement. Getting the insurance and the property tax was easy, and CMHC has their benchmark standards for some other stuff. In this particular case, when I saw the utility statements, the water bill was excessive, to say the least, for at least the first 3 months of ownership. But the borrower had recognized this, and they brought in an expert to take a look at it, and they found a serious leakage problem, and so that was fixed. We were able to get the backup from the company that did it, and backup letters explaining what they did, and show that that expense had stabilized. And in the end, CMHC approved the loan and approved a bit extra so that the borrower can continue doing some ongoing renovations.
That was a good result. Before we move on to our third case study, I just don't want to pass by comments from Shane and Lindsay about on the accessibility side. Both of them are doing some work in this area and having some decent success at creating accessible housing. So that might be something people can look at a little more closely as they move along.
We're doing a webinar tomorrow.
Yes, and they're doing a webinar tomorrow. I think Donna posted something on that. So if accessibility will get you points, and it's maybe going to be a little easier than some people think, catch that seminar or that webinar tomorrow. So let's move on to
Barry, have we got a link for that webinar tomorrow that we can?
I think Donna's going to
Yeah,
pop that up for us.
Great.
So we've got a whole bunch of questions, but there was also a case study on purchasing an existing asset in Alberta, as well as the refinance.
Well, the third one, it's purchasing a new build.
Oh, it's a new build. Okay.
All right. Yeah, I mean, I don't. There's not really a lot. I mean, that one's fairly straightforward. We're working off pro forma expenses, but again, CMHC does have some operating benchmarks for Alberta that we can work off as well. Okay. But yeah, I mean, it's in this particular case, it's probably 2 years from when, or 18 months at least, from when the purchase agreement was signed until the property is ready. He's looking at about 86 or 87% loan to value on MLI Select. And this is one of the ones where it's got, a basement 1 bedroom and upstairs 3 bedroom. Mm-hmm. And there's 4 and 4. So the affordability is very easy on this one.
All right, let's pop up a few more questions before we get to some of those other discussion points. Lots of questions, so let's see what we got, Donna.
Will you ask them if they will come back and do it?
Will I ask you if you'll come back and do another?
Yeah,
one?
absolutely.
Thank you.
The answer is a big yes.
Yeah, that's an easy question.
All right, Aurora, are there limitations on how much you can increase rents that are designated as affordable units? I'm pretty much sure there would be, or as long as they're below 30% median, you can increase as the new benchmark increases.
Yeah. Well, median renter income should go up with inflation. So every year CMHC will publish their new list, of what median renter incomes are for various markets, and you can increase your rents as median renter incomes go up.
Okay, so stay within the guidelines, you can increase the rent. Next up, thanks for sharing. I'm looking at a new build rural area here in Nova Scotia on vacant land that I own. Is there a population restriction for this program?
No, there's not anymore. I mean, there used to be, but I mean, I know somebody in our office recently done one in a 5,000 person market in Saskatchewan.
Okay.
The difficult part, will be the loan amount.
Yeah.
Depending on what the budget looks like.
So smaller loan, Nova Scotia. That was, I think, your comment previously, Neil, is that the lower price and cost there is a barrier for finding lenders who will do the deal.
Yeah, and it may make sense on that one to do the construction, non-CMHC with maybe a local credit union if you don't really need to push the loan to cost, and then look at MLI Select for the takeout.
Okay. All right, Donna.
Okay, well, they're just coming in fast.
They're coming in fast and furious.
We'll have to.
Irina says, what about a combination of financing on multiplexes across Canada, including BC and Vancouver Island? Not sure I know.
I'm not sure I understand that question.
Yeah, not sure what. Irina, we'll go to somebody else and you can give us a bit more detail on what that is.
I mean, if she's asking if you can put them all together under one umbrella, I don't think you can. I think you have to do each property individually.
Okay, we'll see if Irina updates. Kyle says, can the net worth be distributed between the partners in the deal?
Absolutely.
Well, good. That's a good point. Good question, Kyle. And nice to hear that absolutely answer.
And the other side of that is that those partners are guarantors on the mortgage.
Yes. Yes. Everybody gets added in, don't they?
Yeah. If you're going to use that net worth to qualify, you have to use it as part of the guarantee.
All right. What's Bill up to? We got a lot of tired landlords, underperforming properties in Atlantic Canada. We often see properties with rents 25 to 30% below market rates. Is there a maximum increase in rental income or NOI CMHC will permit on a pro forma versus the most recent financial statements?
Well, I think the answer, I just, if I could jump in, typically on that's the kind of an asset that you do a two-stage financing plan on. You'll buy the asset and get it stabilized, get the rents up, get your expenses down, and then come back and put an MLI Select takeout mortgage on it once you've done that. So it'll require some short-term financing. Neil?
The general rule of thumb is that your financing is going to be based on existing income, not on potential income. You can use any rent increases that are going to take effect within 60 days of funding or closing. So, if you've given your notice of rent increase, a week or 2 weeks before closing, you can use those rents, but you can't use potential rents.
Okay. All right. Well, is the CMHC insured mortgage always assumable? I think you probably answered that, Neil, but
they're always assumable as long as the borrower qualifies.
And it's same qualification process as if you were getting a new loan, pretty much?
Well, you don't have to go through all the details on the property. So you just have to qualify the borrower.
Okay. All right. Bill says, thanks. Let's go one more before we get into some other things
Well,
on
that's
the
it.
list.
We're all done.
We're all done. No, Eric says, will CMHC allow a refinance to pull equity to pay owners down payment back?
The CMHC's really tightened up on that. You used to be able to do an equity takeout for just about any reason you wanted to. Now you can only do an equity takeout to either put money into the subject property or to put money into a 2-unit or more property that you own. If you want to do repairs or do anything on another property, or if you want to purchase another property. If you've got, something that you've got a purchase agreement on. If you bought the property and you put some repairs and maintenance into it yourself, or some capital upgrades, within maybe the last 6 months or 9 months, I think you can probably reimburse yourself for that as well. But you can't get the down payment back.
Got it. All right, gentlemen, we've hit the 6 o'clock mark, and we promise folks we'll do an hour. There's still a number of things on discussion points. Garth, we didn't talk about your associate, Nicole. You've said you'd come back. I mean, I'd like to have you come back because, my goodness, that hour just flew by.
It did.
What do you think?
Mhm.
So is there anything that you'd like to finish with, Garth? I'd like to just remind everybody again that you said that if they email you with the listing, rent roll, and pro forma, you can give folks a pretty quick answer on how their proposal looks. So I think that's important. Donna did pop up your contact details. She'll likely do that again in the comments so people can look there. Garth, do you want to talk about your associate, Nicole?
Well, I sure. So on the residential side of my mortgage business, I have partnered up with Nicole Ilge, who's 19 years in this business between CMHC and a couple of banks. It's going very well, and it's freed some time up for me to be more reactive, both on the multifamily and commercial side, as well as on the conventional residential side. And at some point that becomes an exit for me as well. I want to leave my book in good hands, and there's no better way to do that than to work for a few years with somebody who's going to eventually take that book. So we're just in the middle of announcing the branding on the team, et cetera, and that'll be out here in the next short while. The other thing I would say is, for anybody with any questions that were not answered or completely for anyone on this call, feel free to email Neil and I, and we'll do our best to answer them. And if it means that we need a call, we'll do that. We're both pretty available.
Okay. All right, gentlemen. Well, that was an illuminating session. I have to say, I learned a lot. The hour, just as I said, flew by. Great questions from everybody. Extremely useful. Guys, we'll debrief this and see whether or not we have more to add for coming on at another time. Maybe more case studies. Maybe there'll be some further developments as you do more of these. But at this point, I'm going to say, wow, what a great session. So, Neil, so nice to meet you virtually.
Yes.
At least.
Thank you for having me on.
You're more than welcome. And Garth, always fun talking to you.
Mm-hmm.
So thanks for setting it up and doing such a great outline for us and bringing your collective knowledge, and also interesting to hear about Nicole. So on that note, gentlemen, we'll say goodnight and look forward to the next time. All right.
Okay. Good
Thanks
night,
again.
everybody. Thank
Good
you.
night, everybody.
Good night, Donna.
Okay.